Hello traders and welcome to the weekly market report. I'm AJ Monty and this is a one-year daily candle chart of the Invesco Trust, which tracks the tech sector, ticker symbol QQQ. As I do each and every week, I leave my lines on the chart so you can see how the forecast worked out. And I had a 2-week forecast on this one that started out with a forecast to the downside, and then I said we would most likely bounce, and that's exactly what has happened. In fact, we closed right at my target. It doesn't happen too often like that, but right to the penny it closed. And so what does that mean for next week? Well, as I erase these lines and draw the new forecast lines, I want to point out this candle right here, this green candle, and the body of that green candle is falling within the previous body red candle right there. That's known as a harami. Now, in addition to that, while that is bullish, there is a gap above the market right there, right at the moving average, that is still left open. So I think early in the week we could possibly go up to fill that gap, and then I think we're going right back down towards the end of the week, possibly all the way down to these lows here. So upside target to fill the gap is 360, 365. And then I'm expecting the volume to drop and a turnaround back down to 343.30. So keep your stops in place and make sure, especially the option traders, that you're managing risk. Now, if we look at the diamonds, which is ticker symbol DIA, basically tracks the Dow Jones Industrial Average. You can see that I left my lines on the chart again, said we would drop, bounce, and right there at the end of the line was my target of 348.50. Not only did we hit that early on, we surpassed that. But notice what happened right here. The moving average acted as resistance and the stock pivoted right back down. Now this is going to be a little bit different than what we're seeing in the QQQs, because I think what will most likely happen is the diamonds are going to most likely drop and continue lower. So I'm going to go straight down just like that. Look at the stochastics hinging lower, and the CCI didn't even get to overbought territory. It's starting to move lower, and we might see the CCI cross below that momentum line early in the week as well. So keep an eye on that. Downside target for DIA, 343.17. Now let's take a look at IWM. This is one that I've been talking about for a good long time. In fact, on May 20th of last year, I called the topping pattern that was forming. I didn't call the high. Again, I got to keep saying that because people misinterpret that. I called a topping pattern. That was back here in May. And look where we are now. I was also talking about the support level of 210 breaking and what would happen after that breakout to the downside. Well, that did occur, and now 210 becomes a major resistance level. Now look what's happening down below here, right around 192. Let me zoom in there for you. Remember last week and the week prior, I had these forecast lines going, and I said we would most likely go down, test support, which we did, bounce and go up, which we did, hit that target of 202.80 early on in the week. And now again, that resistance is acting right at the moving average. Now for IWM, you got to really watch this one, because I think we're going to go lower and test this low. We might bounce, but the reason I say might bounce is because we have to take a step back and look at the weekly chart on this one. If you look, there really is no other support level other than this low right there. See that? So if we break out below this support level, we have a gap all the way down here on IWM that could be pretty painful for those of you that are holding the small caps. So be really careful. Risk management should be a top priority of every trader and investor, and I'm just putting that word out. Look at that. Again, my downside target for IWM is 189.06. Now let's hop right to the spiders. Ticker symbol SPY. It's the S&P 500 ETF. Leaving my lines in place, did the same exact thing. It was pretty much the same recipe for all the markets right across the board, where I said we would most likely go down, bounce, and then this week I said we would most likely go up. And what I did, if you recall from last Friday, I extended that line up to 446.75. If you like, you can go in the description box and review the report from last week. I intentionally do that so people could make sure they understand what I'm saying and they can follow through. It's a great exercise, by the way. If you go and click on the weekly market report from last week and see how the forecast worked out, it'll help you develop your own eye for looking for these signals. Now, SPY, again, it's kind of like the Qs where we have a little gap there above the market. Let me erase all these lines and zoom in there for you. You see that gap right there? It's right from the bottom of that candle on Wednesday, and I'm going to draw that straight across. I do think that we could rally on the spiders just a tad, and then I think it's going to take a big dive lower right down to 432.57. 432.57. So again, initially I think we'll fill that gap. And if you follow my gap fill rules, 80% of the time gaps fill. But then after they fill, 80% of the time prices reverse. See this gap, what happened when it filled? It filled and then reversed. That's what's happening, but we're looking at the opposite. The gap is above the market. So if it fills, we'll most likely reverse and go lower. Now I'm going to make a big call on the VIX. If you remember last week, I called an official end to the bull market based on my analysis. It's nothing more than my analysis of the charts. And I called an end of the bull market. The major trend lines are breaking. Moving averages are rolling over. Where the Qs are down below the 200-period moving average, and it's getting worse. So I think that we are at risk for a big move lower. I am ultimately calling for a crash. Don't get upset about that, because on Monday night and even on Tuesday, I'm doing a webinar with John Nigerian on Tuesday. I'll give you the details in a moment, but we're going to be talking about strategies that you can embrace even in a bear market. There's no need to panic or get spooked unless you are a long equity holder and you absolutely refuse to sell any of your positions because you're afraid to pay the taxes on that. I think that's a very risky strategy at this particular point, because, I mean, if you're paying the taxes, it means you're making money rather than riding it all the way back to your cost basis, not having to pay the tax, but then you wipe out your profits, right? It doesn't make sense to me, but a lot of people are in that position where they don't want to pay the tax bill. Anyway, here's the VIX. What I think is going to happen, and look what we did. I extended this line last week to 25.32, and we did that. I do believe, I'm going to erase this, I do believe that the VIX is going to drop just a little bit. You see what we have here is a bearish harami, small little baby candle within the body of this green candle. So I think the VIX is going to go down and test that support level. Now here's my big call that's going to stay in place for a good long while. I'm calling for the VIX to rally over 40, and I'm going to put it to 42. Let's see if I can get it to stick there. It's not going to stick. Let me do it this way because I have to condense the price action. I'm calling for the VIX to break out over the highs here, and it's going to get up to here around 42. That's my forecast. It's a long-term forecast that I'm leaving in place to the end of March. And if you look at the oscillators down here, the stochastics is going up, CCI is hinging lower. Hence the reason why I think we're going to see that drop early in the week. And then once it bounces off of this key support level here, I think it's going to be a very tough time for anyone holding long positions, because remember, for the most part, the VIX is inversely related to the S&P. So if I'm calling for a breakout of this high on the VIX and much higher levels, percentage-wise especially, then that could be a rough ride for those holding equities, because they'll be bearish for the market. Now, as I mentioned on Tuesday, John Nigerian and I are going to be doing a webinar on Tuesday. It is free. Go to my Twitter page right there. You can click on the link right there on that page, and it will bring you to a registration page. It is free. Remember, all you have to do is put your name and your email address, and they'll send you the link, and it's going to be an action-packed hour. Remember, I'm going to be talking about strategies that you will be able to incorporate even in a bear market, help remove some of the anxiety that we see mounting in our investor community, and maybe even excite you to the point to where you'll want to learn how to trade options. For those option traders that are out there, I'm going to be talking about spread trading and how to manage your risk trading options as well. So you have a great weekend, and we'll talk to you soon. Remember, like, share, and subscribe. You're helping everyone when you do that. Have a great weekend. So long.